Good afternoon, everyone. My name is Dean Piccirillo. Welcome to our presentation on the CARES Act retirement plan relief provisions. I'm the partner responsible for the firm's retirement plan services group on a national basis. We provide a range of consulting to companies sponsoring qualified retirement plans and work closely with our colleagues in the accounting firm. HBKS Wealth Advisors is one of the nation's largest independently owned registered investment advisors. We manage nearly $4 billion for thousands of clients around the country, and we've been part of the HBK family of companies for 20 years. I want to introduce my co-presenters today. Rod Diaz. Rod is our National Retirement Plan Account Manager. He's based in our Warrendale, Pennsylvania office near Pittsburgh. Rod has been practicing for 25 years and works exclusively with our firm's corporate clients sponsoring qualified retirement plans. Also want to introduce Bob McNulty. Bob is the president of M2B Consulting. M2B specializes, they're a national third-party administrative firm for qualified retirement plans. They specialize in complex retirement plan design consulting for both defined contribution and defined benefit plans, so both DB plans and plans like 401ks, 403bs, 457 plans, etc. Bob's firm is headquartered in Pittsburgh, but he services clients around the country, and we at HBKS Wealth Advisors have a number of mutual clients with Bob and his firm. Today, we're going to be talking again about the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, which was signed into law very recently on March 27th. And the CARES Act provides significant relief to American taxpayers, families, and businesses in a variety of areas. The focus of our conversation today is very specifically related to retirement plan sponsors. There are significant temporary enhancements to how your plan participants can take distributions from the plan, apply for loans. There are modifications to required minimum distributions that we need to be aware of as plan sponsors, along with a number of other issues. Further, as plan sponsors, there are tools that during times of business distress that we're all going through, there are tools that you should be thinking about it and be aware of, and we'll spend some time discussing those. They're not specifically related to the CARES Act, but certainly a number of things that you should be aware of. Lastly, there's some ongoing fiduciary best practices that should continue to be adhered to despite the business and personal stress that we're all feeling. We'd like to get to the bulk of the material by, let's say, 1:50 p.m. or 1:55. We are going to be watching the clock closely and moving fairly quickly. We're going to open it up for questions at this time, and we're going to stay on the line until about 2:30 p.m. to field questions as they come in. If you have questions as we're going through the presentation, you could submit them through the chat function, and try to make the selection where you can submit questions to staff, and then we'll start there. And then there'll also be an opportunity to, using the GoToWebinar app, raise your hand, and we can take questions verbally as well, depending on how we're doing on time. The entire presentation is being recorded, and it'll be available to be streamed within 24 to 48 hours on both the HBK and HBKS website. And of course, you can always feel free to contact us directly with any questions that you might have. You can easily find our contact information on the HBKS website, and you can always get a hold of us if you're an existing HBK CPA client. You can always get a hold of us through your HBK CPA. I just want to mention, though, before we jump into the actual presentation, you can find a lot of great information, tremendous amount of information on the financial and economic aspects of the coronavirus pandemic and the provisions of the CARES Act on both the HBKS Wealth Advisors and the HBK CPAs and Consultants websites. Just find the homepage, and the links are there on a whole range of issues impacting both personal and business clients of both firms. So with that being said, as a way of introduction, I'm going to turn it over to Rod Diaz, and Rod is going to talk about those CARES Act provisions that are very specifically related to retirement plans. Rod?
Thank you, Dean. I appreciate it, and thank you all for joining us today. As Dean mentioned, this CARES Act is essentially part of a large, epic stimulus bill that the government has passed for these unprecedented times when millions of businesses are facing challenges due to the COVID disease. The CARES Act specifically, what we're going to talk about today, is a piece of that stimulus bill, which really is related to retirement plans and retirement plans arrangements specifically. It's sort of a two-pronged approach. The first prong is really an intention to create liquidity within the system, to basically create dollars available for individuals during these times. And the second prong is tax or forbearance or relaxation, if you will. We'll cover that. As regards to the liquidity options, there's three provisions that we're going to see essentially come into play: distributions, loans, and required minimum benefits. And the first of which is distributions. So the CARES Act creates a temporary new type of distribution available in retirement plans. It's somewhat similar to perhaps an in-service distribution or a hardship distribution, but we'll talk about those more in more detail, how they're different. But this type of new distribution, which is temporary, as I mentioned, it's offered through December 31st of 2020, allows the employees of a retirement plan, the participants of a retirement plan, to withdraw up to $100,000 or 100% of their account balance, whichever is lower. Now, this is across all plan types. So if you work for a company that has say a 403B and a 457, that maximum would be across both plan types, or say a 401k and an ESOP plan, it would be across those plans. Bob, any comments on that so far?
No, the only thing to add, Rod, and I appreciate being included today, is just the 100,000, 100% can be set lower if the plan sponsor likes the idea, but wants to limit the access to dollars. It's just that how the plan is eventually amended, and we'll certainly talk about that as we go forward as well.
Absolutely, thank you. Great. Could we move to, oh, you're already on the next slide. Thank you, Dean, appreciate it. So we talked about how these distributions are somewhat similar to in-service distributions, but for those of you that have plans that already have in-service distributions, you know that those are subject to people perhaps of a certain age, or there's some discrimination that allows some people to receive in-service distributions. Sometimes it relates to some money types, but not others. These coronavirus-related distributions, which I assume we'll probably be calling them CRDs or CBDs or something along the line. We'll find an acronym here to talk about them. They're unique. They're not like the existing in-service distributions. They stand on their own. Hardship withdrawals are somewhat similar, but hardship withdrawals sometimes can be subject to a 10% penalty. These are not. So here are some characteristics about coronavirus-related distributions that make them unique. First and foremost, we know they are temporary. They are not subject to the 20% mandatory withholding. Generally, any amount that is rolloverable is subject to a 20% withholding when inside of a retirement plan. These are not, so that's an important distinction. They are not subject to the 10% penalty, which sometimes hardship withdrawals are for those people that are 59 and a half or younger. Basically, anybody who's taking one of these corona-related distributions, and we're going to talk about who are the people that are eligible for that in a minute here, will not be subject to that 10% penalty. They are, as I mentioned previously, they are rolloverable. They are rollable into another arrangement. You can roll these into another plan. You can roll them into an IRA. So that's an indirect rollover. So basically, you can take these monies out today and you have up to 3 years basically to put them back if you so choose to. If you don't put the monies back, if you don't roll over this money, this distribution, then it does become taxable, and it will be taxable over basically 3 years. The mechanics of how exactly that's going to be taxed, honestly, we don't know the details of that. This law came out essentially a week ago, so I'm sure we'll be reading more and more about this with time. But for now, these are the characteristics that make these distributions unique. Bob, anything on that?
No, that's exactly right.
Perfect. Could we have the next slide? Thank you. Okay, so who is eligible to receive one of these coronavirus-related distributions? Well, the way that I summarize it is by saying that you are either afflicted by the virus, you or one of your family members is afflicted by the virus, you've been diagnosed with the COVID-19 illness, or you are affected by the virus, meaning you have experienced some adverse financial consequence as a result of the quarantine, furloughs, maybe you've been laid off, your hours have been reduced, or your children don't have childcare, and you've had to take over that responsibility. One of the interesting things about this COVID-related distributions is that generally when there's as we mentioned earlier, sometimes they look similar to hardship distributions. Generally, when there's a hardship, one has to find the evidence and document the reason for the distribution. In the case of the coronavirus-related distributions, these are self-certified by the employees. That's a very unique characteristic. Basically, the employee will determine whether they have been afflicted or affected by the virus, and as a plan sponsor, you don't need to verify that, other than what we would recommend is that you, in some form of writing, document this self-certification. And I'm sure with time here in the next few weeks, forms or sample letters will arise by your providers and by us, the advisors, to help you accomplish this. So again, anybody who's affected or afflicted by the virus essentially is able to avail themselves of these distribution options, which, given the circumstances, could be a very wide group of people. And secondarily, it is self-certified. So that is kind of unique. Anything to add on that?
No, I think Rod, the self-certification is an incredibly important aspect of what will happen here. And ordinarily, as you said, plan sponsors have to make sure that they've gotten the proper justification, and because they don't, that makes it an extremely unique opportunity. But it also means that the industry needs to give some thought to that certification process and what they're doing to ultimately make sure that there's some formalization to the employee's election. So undoubtedly, we'll be seeing folks as part of the distribution process asking participants to self-certify in writing, beyond saying something just like, by signing, we're assuming you qualify. There'll be something more specific than that.
Correct.
Hey, Rod, it's Dean. I can make one point here. Although these are available, and you'll cover this in a later slide, I know, but although these are available, plan sponsors are not compelled to offer these coronavirus-related provisions within their plan. So we'll talk about how you might want to think through that, or Rod will.
Yep.
So
we'll
that's
talk about
something to consider. But I think one thing that is very relevant is a lot of record-keeping platforms have already gone to a negative consent model, where they are going to include these provisions if your participants call them and ask them for distributions, unless you tell them as the plan sponsor not to do that. Newport Group, for example, is one record-keeping firm that is sent correspondence to their plan sponsor clients saying, if you don't proactively tell us not to include these coronavirus-related distributions and loans, we are going to. So the one one thing I would encourage everybody to do today or tomorrow, because these things that, Newport gave a very short window as to when you had to get back to them. I know other record keepers are as well. I would encourage you to pick up the phone and call your platform provider and your advisors and find out what their stance is going to be on this. Because I think regardless, you're going to want to think through the implications of whether or not you want to offer these to your participants. So thank you.
Great. Thanks, Dean. So the second form of liquidity measure that's offered to us through CARES is related to loans. And somewhat similar to the distributions, basically they've increased the loan maximums essentially. And again, this is optional. You don't have to do this. You don't have to offer these. These are guidelines, if you will, but you have the ability to offer your plan participants loans of $100,000 or 100% of the vested account balance. Now, this differs from current loan provisions, which are usually set at $50,000 or 50% of participant vested balance. So here what we're seeing is a general increase to the limit and availability of loan funds. One thing to note is that, again, this is a temporary measure, but this increased limit is available for 180 days. So that's going to be a September 27th, 2020 deadline for this increased amount. You'll still be able to apply for loans after that, but you will not get the benefit of the $100,000. The second feature within loans that's being offered through the CARES Act is a suspension of any current loan payments for those people that currently have loans or are in the midst of repaying their loans. They can request a deferral, if you will, of up to 12 months for their current loan. Now, this does expire on December 31st, 2020. We interpret that to mean that anybody who wants to put their loan on pause for 12 months must do so before the end of this year. That's how we interpret that, but certainly there could be more guidance giving us a better interpretation of what exactly that means, but that is how we read the law at this time. We are also interpreting this CARES Act to mean that we can actually stack or combine these two features. So we believe that if this is being offered through your plan, if you so choose to offer it through your plan, that an employee could come and request a $100,000 loan, for example, and immediately put it on suspension. So we view this as a possibility of combining these two features. Anything to add on that, Bob?
Yeah, a couple things here, folks. On the loan limitation, we're still bound by a reduction to those maximum loans for any existing plan loan. So if we have that $100,000 limit, for example, in terms of the maximum borrowing, if there's an existing loan for a person in place, let's say the $25,000 over the course of the last 12 months, that $25,000 would reduce the amount available in a COVID-19 loan. It should also be noted that it is possible to add the loan provision under the CARES Act without necessarily otherwise allowing loans as a provision of the plan normally. Certainly that's going to have to be required to be part of the amendment that eventually gets done and that we'll be talking about. But the loans specifically for this crisis can be taken. The record keepers will obviously have to be informed and have to be set up within the system, but it is possible to have a temporary loan provision in that way.
Thank you, Bob. Appreciate that. Very valuable. So again, who qualifies for these loans? Generally, while they're seem to be made available to everybody, again, we're being defined by a definition which says that it's somebody who is either afflicted by the virus or affected by the virus. Very large swath of the population, but I guess, if you're unaffected by COVID in any way, shape, or form, it would make you ineligible for this type of relief. But most people, and especially because of the self-certification, it's up to them whether they're going to avail themselves of this relief or not. Okay. The next area that we want to talk about is not so much a liquidity prong or effort, but more of a relief/forbearance. And this is related to required minimum distributions, or RMDs as they're known most commonly. Essentially, for the year 2020, RMDs are waived. What does that mean? Basically, you're not required to take a 2020 RMD. You simply don't have to take it. It's not that it's being postponed till next year, and next year you have to double up on it. You just simply do not have to take your required minimum distribution. And so, if you recall, required minimum distributions are generally for people who are either 70 and a half or older and have started taking distributions prior to 2019, or for new folks, the Secure Act, which passed recently in December of 2020, moved that date of 70 and a half to 72. So for the year 2020, it would be individuals starting their RMDs who have exceeded age 72. Those are essentially what is being waived here in the year 2020. I'm gonna chat about that in the next slide. And this is true for all plans, including IRAs too. So for those of you who are curious about it, this also involves IRAs. Could I have the next slide, please, Dean? Okay. So I apologize. Let's see here. I think we got to go back one. Sorry, I missed your toggle. Yeah. Okay. Sorry. So this raises a very interesting question, because many people have already taken their 2020 RMD. And what happens if you've already taken your 2020 RMD, either because you were 70 and a half and already in the habit of taking your RMDs? Many people take them early. They do a calculation with the December 31st value. This amount now that has already been taken, if you've already taken your 2020 RMD, can be rolled back into the plan. You can return it into the plan, which normally you cannot do with an RMD. RMDs tend to not be rolloverable. So in this case, that's the exception. Also, if your first year for taking RMDs was year 2019, some folks, you have until April 1st, which already passed, to take that first distribution. Since the CARES Act came out on March 27th, you basically had a little bit of time, I think it was a day or two, to cancel your RMD from taking place for 2019 on or before April 1st of this year. So for those folks, they actually get a pass on their 2019 RMD as well as their 2020 RMD. So they get to double dip. And then last but not least is if you have inherited accounts, whether they be inherited IRAs or someone's inherited a 401k account, generally speaking, these folks have the obligation to take out money over time. If it was prior to the Secure Act, they had to take it over their lifetime. If it was after the Secure Act, they had to take it out within 5 years. The new law basically gives folks the ability to extend that 5-year period into a 6th year, much like the suspension of the loan. That year will basically not count against them. And for those folks that are taking it over their lifetime, they basically don't have to take it out for 2020. And the reason behind this is because the markets have declined. RMDs are usually calculated on December 31st values, which relative to where we are today in the market's generally higher. And it's giving the people the ability to not have to take a liquidity event, not have to sell their securities here in these lower markets. So that's one of the reasons. And the other reason, of course, is to inject, to a lesser extent, inject some liquidity into the system by not forcing people to have to pay these amounts. Anything to add on that, Bob?
On the required minimum distribution, we have a number of record-keeping partners that set up the required minimums to happen automatically, and so plan participants need to be aware that if their RMD is scheduled to happen because they've made a previous election, they need to be careful of that. Certainly, if they're not wanting that distribution to occur, they need to stop it. If they do want it to occur, but the plan doesn't otherwise allow for non-RMD partial payments from the plan, there could be a compliance issue there that needs to be thought about. So certainly as we get more guidance, that will be another area that we want to make sure that plan sponsors and practitioners are careful of.
Excellent. Good points. Excellent. Very good. We're already on the defined benefit relief. This is a secondary measure of relief / forbearance. DB payments normally made quarterly can now be delayed till January 1st of 2021. This is by no means a forgiveness of the benefit that needs to be paid. Basically, the funding requirement has not gone away. All it simply is a delay in making the payment of that obligation, of that funding obligation. Okay. Now let's talk a little bit about the mechanical aspects of implementing these changes. So if any of this seems interesting, if you as a sponsor would like to offer any or all of these features, you can do so immediately, but you will have to amend your plan eventually to allow, quote unquote, for these features to take place in your plan. You have to write them into your plan document. Essentially, you have 2 plan years if you have a corporate plan to get this done. So it has to be done by the end of your plan year starting in the year 2020. If you're in the governmental end of the retirement plan spectrum, you have essentially 4 plan years to get the plan amendments done. So again, as Bob mentioned earlier, these are COVID specific features that would be added in your plan. Your plan can not have a loan feature built into the plan, but you could allow for COVID related loan provisions to take place. So again, you have that flexibility, you have that option to add that into the plan, but your plan will ultimately have to be modified. And to Dean's point, as he mentioned earlier, is you'll need to check with your record keeper and certainly with your advisor as to whether this is happening automatically for you or whether you need to give consent. So the folks that are basically doing this through negative elections, such as Newport Group, as Dean mentioned earlier, some of these decisions are kind of being made for you. So you'll want to look into that to make sure that you're in agreement with that. Okay. The next point that we want to make is that you're going to have some decisions to make here. These are all optional features, and you're going to have to decide which of the features you want to make available to your participants, to your employees. And again, highly encourage you to check with your advisor, check with your record keeper to make sure that that you end up with the provisions that you want. Okay. Slide 15 and 16 will kind of go together, so we'll cover them sort of together. But for now, you can do nothing, especially if your business is relatively unaffected. And part of the reason is that, as I said earlier, these provisions are a week old, and with time, we're going to get a little bit more clarity. We're going to get a little bit more technical amendments that will come out so we can better understand them. So perhaps at this moment you wish to do nothing, but you also have to face the fact that your employees may grow a little bit if you are affected by the virus and you had a lot of layoffs or furloughs. Your employees may be actually rearing to go with some of these provisions. They may want to avail themselves of these loans and or distributions, or so keep that in mind. And as we said multiple times throughout this presentation, is that these features are optional. So you could choose, for example, to offer the increased loan provisions without necessarily offering the distribution provision. So you could do one, but not the other. Or you could offer an increased loan provision and set it at, say, $75,000 or 75% of account value. You don't necessarily have to opt in for the highest level. Or you could offer the distribution-related provisions without offering the loan provisions. And you may want to do that because, after all, loans upon termination become immediately payable. So you have to, always be aware of that. If you allow a participant to take a loan, and then for some reason they lose their job permanently, that loan becomes payable eventually in full. Even if they have the 12 months to defer it, eventually that loan will have to be come in. So you could choose to do one or not the other, and there's perfectly good reasons for offering one versus the other. Again, highly encourage you to talk to an advisor about this, or you may choose to offer them both, and you may choose to offer them at the highest levels. So again, a lot of choices here, a lot of decisions to be made. We can't urge you enough to chat with somebody and discuss them. Okay.
Hey, Rod, can I just comment, expand upon this a little bit? There's certainly a number of decisions because, again, as Rod has mentioned on several occasions now, all of these provisions are optional. You don't have to offer them, but again, you'll want to see what position your record keeper is taking, so that they don't start offering these provisions to your participants without your direction and consent. But not only there are a lot of decisions that plan sponsors have to make, but ultimately, if you decide to make these available at some level to your participants, there's a lot of really important decisions that they're going to have to make as well. I mean, just that one distinction of understanding that a rollover could be taxed ratably over 3 years and rolled back into either an IRA or to this qualified plan or to another qualified plan versus the loan, that if it is defaulted on, becomes 100% taxable in year one. That's a conversation that a participant should have with a professional advisor. Obviously, if you're an existing HBKS client, we can connect you with tax professionals that can help your participants think through that carefully. Obviously, if you're not, you're going to want to make sure you have, working with your advisors, a good communication plan for your participants as you roll these things out. And then I guess I would, because Bob and I had talked about this a little bit yesterday, he's already having conversations with his clients, with his consulting clients, as to whether or not they want to offer these. And I thought it was one interesting perspective was, Bob, you have some clients who are offering this just so that it's available as a safety valve, but they're not necessarily broadcasting to their participant group that it's currently available. Can you kind of just talk about that aspect of this?
Yeah, certainly. So ordinarily, when a plan is amended to allow for a new provision like a loan feature or something like that, and the plan's being overtly amended, there's a process of notifying the employees of that change or the participants of that change through summary material modifications, effectively an amendment to the summary plan description. With the CARES Act and having operational compliance with these things being added, well, it makes it very interesting to see, well, what information are we providing to employees? Certainly from a best practice standpoint, it stands to reason that it may be a plan sponsor might want to provide some sort of notice, but in truth, because there's no amendment occurring today, we certainly have talked to clients and said, look, we want this to be available so that when we talk to our employees, when they've talked to our investment advisor, when they've talked to the various and sundry professionals associated with the plan, then we can make them aware of this option. But we're not necessarily in all cases going to blast this out to make it so that there's a lot of distribution or loan requests, without necessarily having gone through that process. So it's been some very interesting conversations so far.
Thanks, Bob.
appropriately, this next slide 17 here tells us that really participant education will be critical, regardless of what combination of features you choose to offer. Your employees need to be informed of the tax consequences of those decisions, as well as, how to best, personalize it to their needs, to their goals. So good two-way communication will be essential moving forward. Listening to what the employees need, require, as well as communicating to them what may be coming. Now, obviously, Bob just mentioned that some people are offering this and not trying to broadcast it, and it's a measure to ensure that people don't abuse these features, because like anything, it can be abused, and employees could hurt themselves either by taking loans or taking these distributions and essentially depleting these retirement plans that we've worked so hard for them to build balances in, now could all easily be undone. So that good two-way communication is essential with participants, two-way communication with advisors, both financial and tax advisors. And of course, we as advisors stand ready to help talk to your employees to help mitigate some of those situations that we spoke about earlier. So with that, I will turn it back to Mr. Dean Piccirillo.
Thanks, Rod. So we do have one quick question that was relevant to a slide that we just covered, and we don't have a lot of them at this point. So I'll ask Bob to weigh in on this one. The question was specifically the loan suspension. There's suspension of loan repayments. Does that have to be somebody who's impacted by COVID? Similar constraints that we outlined for the coronavirus-related distributions and coronavirus-related loans, or can anybody suspend their loans?
Yes, it appears that the suspension also would follow the same sort of criterion for qualification. Now, again, as we've said, and probably sound like a broken record at this point, there's going to be a lot of technical clarifications as we roll forward. But as it rolls now, it appears that in order to suspend, an employee has to be able to self-certify their ability to, their impact. But, as you look through the bullet items in that previous slide, in truth, it's hard to fathom that there isn't an argument in some of those latter bullet points of qualification for just about everybody in terms of being able to work or being impacted by the people they work with. So, as it stands, the suspension is only possible if it's a qualifying event.
Okay, thanks, Bob. Okay, now we're going to move away from the specific provisions of the CARES Act as they relate to qualified retirement plans, and just touch briefly on some general considerations during a period of business disruption that we should be thinking about as retirement plan sponsors and consultants. And I guess to reference some of the commentary that Bob has made on several occasions regarding to additional interpretations from the regulators of this law, we think you're going to see additional legislation. And those of us that are monitoring, professional publications and industry lobbyists, they're already weighing in on the next coronavirus-related relief package and further provisions available to make it easier for plan sponsors to operate their retirement plans during this time. So stay tuned, because we think there's going to be more to come, specifically on some of the issues that I'm about to cover. But as it stands, what we're going to review here in this next segment are the rules as they exist now, but things that you should be aware of during a period of business disruption. So the question here is, can I reduce or suspend or eliminate my employer contribution for the year? Talking specifically about company matching contributions or profit sharing contributions or safe harbor contributions. And generally, the answer here is it depends. It depends on whether or not your plan requires specific contributions or whether or not they're discretionary. I'd say for the majority of our clients that Rod and I work with at the HBKS Retirement Plan Services Group, the majority have specifically selected discretionary matching and profit sharing contributions. So they're going to make an administrative communication to their team members, their participants, that the match is going to be 50 cents on the dollar after the first 6% for the next 12 months. So participants can make thoughtful decisions about how much they want to contribute to the plan, but that's not hardwired into their document, I'd say for most. That being said, for certain plans where you're negotiating specific things with your employees, larger plans that have union employees, et cetera, sometimes those contributions are in fact hardwired into the plan document, and the plan itself would need to be amended. So this is, again, going to be an area where you're going to have to go back and talk to your consultants. Also, it's, again, talking specifically about the clients that Rod and I consult directly with at HBKS Wealth Advisors. Many of our clients have selected a safe harbor plan design, and what that safe harbor planning allows you to do is it allows you to be deemed to have passed certain non-discrimination tests, so that highly compensated employees can make the maximum salary deferral contribution without having to worry about a test failure. That is very common planning. But in order to get that particular relief, the fact that you're deemed to have passed non-discrimination tests, you have to make certain required contributions for your employees. Safe harbor matching contribution or a safe harbor non-elective contribution of 3%, and those contributions also have to be fully vested. It's probably beyond the scope of what we want to get into in this particular presentation to get too deep into this, but we have written a piece of content that you can find on our website and that we can circulate to anybody that's interested that talks specifically about this. And maybe I'll let Bob just chime in a little bit about how to suspend, just the highlights only, a safe harbor contribution where it's appropriate.
Sure. Yeah. So safe harbor 401k designs can be suspended mid-year if the business can demonstrate under normal circumstances that they're suffering some sort of a detriment or business hardship that would basically allow them to pull the plug on that provision. It's really why we expect there to be future guidance, is that, again, there's a lot of groups out there that are experiencing that problem. The suspension requires a 30-day notice to participants that must go out before the provision can be assumed to be removed for that year. So here we are in the beginning of April, even if you made the decision today to suspend the safe harbor, it would still require a 30-day tack on in terms of the required contribution spelled out by the formula. So, if it's something that you want to do, then certainly getting practitioners underway to get that notification out to employees to get that 30-day clock moving is an important aspect of it. And then certainly from there, you're still going to be subject to testing for the year. You're still going to require the contribution for the portion of the year that the feature was effective. So, absent any new guidance that comes out, particularly as the year goes on, it could be an expensive way to not have the testing help that the feature usually provides. So again, just to reiterate what Rod and Dean have been saying, is to stay tight with your consultants and your professionals associated with your plan so you get the best advice.
Thanks a lot, Bob. Sorry, I went past one there. Can my employees suspend or reduce their deferral contributions for the year? In most cases, the answer to that is yes. Most plan sponsors have published administrative procedures that define how frequently participants can change their deferral elections. Most plans also allow their participants to stop their deferrals at any time. And oftentimes, again, these are these are not hardwired into plan documents, and these administrative procedures can be modified without necessarily modifying the plan document. Of course, if you're going to modify your administrative procedures, you'll certainly want to circulate some kind of notification to participants of this change. And of course, it's always the best practice to document if somebody is suspending or modifying their deferrals. If you're fortunate enough to be in a position to do so, just thinking about where the markets are at relative to where they were even 30 days ago, it might make sense, economic sense, if it was affordable, and it's not for many people, of course, to actually increase their contributions at this time. So those issues are all fairly straightforward. One point that I do want to emphasize that is critical, and it does come up, even during a normal business environment. Does the coronavirus disruption impact my obligations with respect to employee deferrals and loan repayments? And the crisis does not reduce your fiduciary obligation as employer related to depositing employee contributions in a timely manner. Plan sponsors are generally under the gun if you're withholding a salary deferral that's been earned and elected to be deposited into a defined contribution plan. You're under the gun to deposit that as soon as administratively possible. For companies with fewer than 100 participants, employee deferrals and loan repayments should be made no later than 7 business days after the payroll date. And if you're running into any issues, you should notify your record-keeping firm, your accounting firm, your CPA at HBK, and the administrative firm immediately. It's a big deal. We do have plan sponsors, and Bob, because he has a large practice, I'm sure he has many every year clients that'll go through Department of Labor audits that are random in nature. And this is something that the regulators really focus on. I mean, we've seen them request years worth of payroll records and drill down to at the individual participant level to make sure that plan sponsors are meeting this requirement. So yes, please continue to pay attention to the timeliness of salary deferrals and employee loan repayments. How do layoffs impact the viability of my plan? This is one of those areas where we are expecting some additional guidance from the regulators, from the DOL, et cetera, and we may also see some additional legislative action. We know that the industry lobbyists are looking to have some specificity around this issue and perhaps some relief hardwired into the next piece of legislation. Generally, as it exists right now, if you lay off 20% or more of your workforce, you are considered to have partially terminated your plan. And if there's a partial plan termination, all affected participants must become 100% vested in their retirement accounts. So there's vesting schedules often applied to employer contributions like profit sharing contributions. And if you lay off 20%, those folks who are laid off must be 100% vested in your employer contributions that you've made. Now, I don't know, Bob, can you add any color to that? Kind of what's your general thinking on how these will be treated? And any thoughts on what you expect to see coming in the future?
Sure. Yeah. So the partial plan termination rules were inputted for situations where a business had to make a decision to change or cut their workforce materially. This wouldn't be a situation where a high turnover business that results in 20% of the workforce being affected, that wouldn't necessarily result in a partial plan termination. And in that normal detail is where most of the concern about partial plan terminations and whether they're really occurring here, where it lies. In a lot of parts of the country and most of the country at this point, folks cannot, and non-essential businesses are not supposed to be operating by mandate. So what does that mean, right? So the business owner has not made an overt decision to cut folks their ability to work that's been imposed on them. And so what a lot of the industry is looking for is relaxation of those rules, to basically specify, look, that if it's COVID-19 related, that there would be some relaxation and not require the vesting. It's also important to note that, just because folks are temporarily not able to work on a layoff basis, it's not quite so black and white that they've suffered or a distributable event, that they are actually terminated employment. If the person is still being paid, then clearly that's an obvious one. But even if they're not being paid, but they're expected to return the second they're able to, then there's quite a dispute as to whether or not the distributable event for allowing for a payout as a terminated employee would normally be has actually occurred. So lots of additional clarification there is needed, and clearly expected, frankly, in one of those additional pieces of legislation Dean mentioned earlier.
Thanks, Bob. It's very helpful. Okay, I'm going to quickly go through some other just traditional plan sponsor fiduciary best practices, things that that every plan sponsor should be paying attention to, really on a continuous and ongoing basis. But they're even, I think, more important during a period of significant disruption in the capital markets. I mean, not out of the realm of possibility that participants could be down 20% or more, even in a broad, globally diversified portfolio, the first, depending on their time horizon and how aggressive they were for the first quarter of this year. And March 31st statements are going to be going out soon. So, I think I like to assume the best with everyone, and that everyone has positive intent, and every one of your team members does. But it's not out of the realm of possibilities that participants may look to challenge investment-related decisions that plan sponsors have made in the past, even if those decisions didn't directly contribute to the participant's recent account performance. Consequently, all of those best practices related to systematically monitoring on the investment options in the plan and monitoring the provider fees that get passed on to participants, and being able to document that you had a prudent process in place for doing so, is even more critical during a period of significant business disruption, where participants might be more inclined to challenge decisions that you've made historically as a plan sponsor. So despite all of the significant distractions, obviously, that all of us are dealing with as professionals and business people, trying to take good care of clients and customers during the current business crisis, we still need to continue as plan sponsors to focus on those fiduciary best practices and document these processes. Plan sponsors, for example, do have a duty to monitor the plan's investments and its various service providers. So we encourage plan sponsors not to table your investment committee meetings. So if your investment committee meets on a quarterly or semi-annual basis, don't table that upcoming meeting in the current environment. You should continue to review your designated investment alternatives with respect to a prudent fiduciary standard of care. Not a bad time to dust off the plan's investment policy statement that should be leading these, guiding these discussions, and make sure that it's still relevant, and that if you've committed to certain processes, that you can document that you've followed them during this time of distress. Plan sponsors also have a duty to monitor service provider fees. The regulators, the plaintiffs' bar, the industry right now is obsessed with fees, and particularly those fees that you're passing on to participants. And again, there's been a significant disruption in the capital markets, historic in some ways. Participant accounts will be down. It may not have anything to do with the fees associated with servicing the plan and providing a high-quality retirement plan to your participants, but that doesn't mean that they won't be challenged and scrutinized by your participants. We think a best practice is to benchmark those fees against other service providers that are providing comparable services and document that you've done that. So again, just best practices that should be continued during a period of significant distress in the marketplace. I've already touched on some of these issues, but again, continue with the continuous and ongoing monitoring of the plan's investments relative to that prudent fiduciary standard of care. Good time to review that investment policy statement. These are all things that if you're subject to an audit or any kind of litigation that somebody's going to be scrutinizing closely. So it's very important to make sure you continue to implement these processes and to document them. And make sure that any decisions that you've made relative to adding or replacing investment options are made based on a defined process, and that you can that they hold up to scrutiny, and that they're documented. Also, it's a good idea to scrutinize participant actions. So many of the service providers that we work with have very good plan health reports that are available. So you can do some trend analysis related to the decisions that your participants are making. For example, are you seeing a lot of participants going to cash now, getting panicked out of their long-term investment strategy and trying to time the bottom of the market? Sometimes these things are pretty obvious when you run some of the reports that are available with some of the record-keeping partners that we work with. Classically, trying to time the bottom of the market and going to cash is usually not the right decision, particularly for people in their 30s, 40s, 50s who have a 20-plus year time horizon. Very few people do that well. So if you're starting to see that, just as an example, that might be help guide you when working with your financial advisor with your overall communication plan. We strongly suggest you reach out to all your plan's advisors and inquire about educational tools that they have available. The major national record-keeping platforms, ADPs, Paychecks, Census, Empowers, Newport groups of the world, the big service providers of 25, 30, 40, 50,000 service providers. They are building excellent coronavirus-related and market volatility pages on their websites with tons of good content you can be referring your participants to. Just a few things to be thinking about with respect to monitoring decisions that your participants are making during a time of significant market volatility. Also, not a bad idea to ask your service providers, firms that you're working with, firms like HBKS Wealth Advisors, the record keepers that you work with, third-party administrators, just ask them about their business continuity plans and their availability to your participants. And as I mentioned, most national service providers have built some good online content. And again, I would refer everyone to both the HBK CPAs and Consultants, and the HBKS Wealth Advisors websites for significant amount of information related to the CARES Act and the coronavirus, our nation's response to the coronavirus pandemic, and how it impacts you, your businesses, and your employees from a tax, personal financial planning standpoint. Okay, so that concludes the formal part of our presentation. We do have a number of questions that have been submitted through the chat function. So we're going to go ahead and try to answer some of those questions. And if anybody else has any other questions that they'd like to pose at this point, you can submit them to the chat function, or you can raise your hand. We'll get to as many of them as we can. and the entire presentation will be recorded and available for streaming on both the HBK and HBKS websites. And for those of you that do need to drop, if there's anything, any way that we can assist at HBKS, the retirement plan group, Rod or myself, or on the accounting side of the practice, please don't hesitate to contact us, and we'll do our best to help you think through whatever issue you're facing with respect to your retirement plan. We're here for you. Okay, so I'm just going to go ahead and take these in the order that they were received, and Rod, Bob, and I will do our best to try and answer them. Okay, can electing to not allow loans and other provisions under the CARES Act indicate a violation of fiduciary duty? My gut, because these are very specifically optional, is to say no, but I guess I'd be curious to hear Bob's opinion on that.
Yeah, I agree completely. The fact that the legislators went to all the trouble to specify that they were optional provisions implies that they are asking plan sponsors to think about whether those provisions are right for them and their plan participants, like they always do. So I think that, you know, as Dean very well, I think, brought to your attention the various fiduciary responsibilities that plan sponsors have, that the potential adoption or non-adoption of CARES is certainly in that category. I want that to be well thought out, and as a result, it's not a mandated requirement that if you didn't do it, it's going to cause you some sort of a fiduciary breach.
And Bob, you can leave your phone off mute because some of these were getting pretty deep in the weeds here from an administrative standpoint that are really more in your wheelhouse. Can a participant who terminated employment due to prior to enactment of the CARES Act still request a distribution? For example, if someone was hired on April 1st and his balance is still with his old employer, if I lay him off, can he request a distribution from his old employer under CARES if he self-certifies?
Yeah, so the act itself doesn't go into any differentiation that way. So if a plan sponsor has added the provision, they're self-certifying their qualification, then yes, they potentially would be able to take that distribution. You know, it's important that that provisions of a plan be extended as they can to both, you know, terminated and currently employed folks alike. You certainly wouldn't want to create a a discrimination event by virtue of not including those prior folks. All of that said, there are provisions that, you know, don't necessarily, as a general rule, are things that a plan sponsor has to do. Imagine that most retirement plans now, with the participant loan feature, are requiring payroll reduction for that loan to be repaid. And if you're going to allow a terminated person to take a loan, the record keeper, by and large, is still not going to accept the personal check from that participant to continue their payments, either now or eventually. So the plan sponsor would have to be willing to, you know, to receive those check deposits and those types of things. So there's quite a bit to think about there, but the law itself, there's no indication that it doesn't apply to terminated folks.
Yeah, thinking through loan repayments for terminated participants, that would be challenging, just understanding existing structures. And Bob, this is something you and I were discussing yesterday, kind of these distinctions between inactive versus furloughed versus laid off versus terminated. You know, how do you qualify or classify an employee who is on inactive status, not terminated? So are they are they still a plan participant subject to plan provisions, or are they like a terminated employee who has access to their entire account via whatever the distribution?
No, again, I think there's going to be a lot of guidance. I think there's going to be a lot of guidance necessary here to kind of clarify these positions. But in the regulatory paths of retirement plans, a seasonal employer, maybe someone who's only open certain times of the year because of weather or other factors, their employees are not automatically considered to have received or incurred a distributable event just because they're in that temporary in-between seasons layoff period. So the distinction of whether an employee laid off, furloughed, all the different terminology that's been thrown out to say that that's always considered a termination of employment eligible for distribution versus not is not at all as black and white as we probably as practitioners would prefer. And so there's a lot of facts and circumstances type questions that have to be asked. Is this person really terminated, or are they just not able to work right now and attend a layoff that were the state restrictions or local restrictions to be lifted tomorrow? Would they be back to work tomorrow, or at least have the opportunity to? The answer is yes. I don't know that whether an employee is actually terminated is as black and white as everybody will like it to be. I suspect it's the kind of thing that will likely be has the potential to be litigated because it's not super clear, and any confirmation or clarification we can get from either the IRS or the government in general would be helpful.
Rod or Bob, we have a number of questions related to RMDs. In particular, probably about a half a dozen questions here related to if a RMD has already been taken, does the 60-day rollover rule apply to get it back into a tax qualified participant account? Is that our understanding that it does?
Yes. So bottom line is the second that the RMDs were deemed to be not required distributions for either the 2019 that were done before April 1 or for 2020, the very second that they were not required as RMDs, that made them eligible for repayment via the 60 days. But that's the hole in the law right now, is that there are a lot of RMDs that took place in January that unfortunately are outside of the 60-day requirement. We're a little more than 90 days into the year, so if distributions took place in January, they are not under the way the law is written currently eligible to be rolled back in. The industry seems to agree that it makes no sense to treat the folks that just took their distribution early different from folks that didn't. And so the assumption is that there'll be some mechanism in a confirmation or follow-up legislation that would extend that ability, that 60 days perhaps to the beginning of the year, or something that would be very specific to COVID-19.
With respect to the loans, there's no indication that the amortization schedule would be anything other than the 5 years, right? I mean, for the COVID or coronavirus-related loans, the amortization schedule. Is the
no, that's actually one of
the
the attractions of the Act. Yeah, so 5 years is your typical required, and basically, if it's possible, if somebody took their qualified for a suspension, it very well could be pressed out to a 6-year and in essence re-amortized. I think the provision was put in place to try to give folks the opportunity that when they are able to repay, that their payment might not have changed much, but they may have to pay it for an additional year longer than their originally scheduled amortization schedule had indicated. It's important to note, and I don't know that it was made super clear earlier, but I'll do it now, that even though the loan payments are suspended, interest will continue to accrue. So, the part of the reamortization will be to add that accrued interest on and reamortizing it over the additional year. And so the payment will change undoubtedly. But it's possible that depending upon the timing and how long the suspension occurs, the payment could actually end up being less.
Do we expect the RMD
Just
waiver
longer.
to apply to all beneficiaries, including trust beneficiaries? And does anybody, have we seen any guidance on that?
We have not. It's amongst a number of other things that people have asked about, although that one is not quite as. Yes, exactly.
All right.
Watching the paint dry.
Right. All right. It's about 2:15, and I think we've covered all of the questions that were specifically submitted through the chat function. I don't see that anyone else has their hand up, so I think now would be a good time to bring this to a conclusion. I want to thank all of you, tremendous interest in this, and frankly in all of the webinars and education that HBK and HBKS is doing for our clients on this matter. So I want to thank all of you for taking the time out of what I'm sure extremely busy schedules to listen in on the presentation. I would again encourage you to reach out to us directly. Our contact information is can be easily found on the firm's website, and you can always get a hold of us through your HBK CPA as well. I also do want to mention that right within the application, the GoToWebinar application, is the handout, which includes all the slides for the presentation today, and there's some other good content related specifically to the topics discussed on the HBKS and HBK website. And I believe we'll be able to do a reply to all and include this attachment to everyone as well after the fact. I want to thank Rob, for the work that he put into the presentation, and I particularly want to thank Bob McNulty for taking the time. Bob, again, president of M2B Consulting. A lot of mutual clients, with his firm. We have a lot of confidence in him, and he's based right in Pittsburgh, but services clients on a national basis. And you can find him easily online as well, and we can connect you with him if you have any specific follow-up questions for Bob. So with all that being said, thank you again, and this concludes our presentation.